Can you move your mic a little closer to you?
Oh yeah, sure.
Or maybe it's down a little bit.
How is it now?
It's still a little bit low.
Okay. I think I need to adjust the settings on the.
Okay. Hey everyone, just one sec. We're trying to get some technical difficulties out of the way.
Is it better now?
Still a little bit low, but go inside of this. It might be StreamYard. So StreamYard has its own settings. So go into settings, go to audio. Then you'll see mic volume at the bottom.
I don't see. Oh yeah, got it. I think this should do the trick.
Yeah. Can anybody else let us know if they're having any trouble hearing either one of us? Don't know if that's the system or one of our mics. We'll see. But hey guys, so we're here. What a crazy week in the markets, kind of very eventful week in the markets. I think a lot of people are surprised. I think there's also another angle on it, which is that some of us aren't as surprised. Kashyap and I don't think we're as surprised that this finally kind of happened. Hey, good morning, Dave. Thanks for letting us know. I don't think we're as surprised. I think there's something that's we've been looking at this market for a while, and if you've been looking at this market for a while and trying to make sense of it, you can kind of see that things have been a little bit overdone, to say the least. We've been on a run for a long time. A 20% correction wouldn't be that insane. It would make total sense here. So once again, I think too many people are going to get stuck in the, hey, why are we down? Like it's going to move down, and we're going to move through cycles and corrections. I think the thing to continue to pay attention to is the rotation out of these leading sectors in tech that have been leading the last couple of years and into these other areas like energy and so on. Like energy still has been holding up relatively great in comparison. And that's the thing I think that's the most important thing to look for when you're watching a correction, is to really look at what's going on in the market and what sectors are going up when the market is going down. And it doesn't have to be going up as in, hey, the sector's green on a red day. That can also be significant. But it can also be something like, hey, this sector is only going down a little bit. Hey, the sector's flat as the market's kind of crashing. Like that's where you're going to want to be positioned next for the next run. Kashyap and I have talked about this for a while. Like basically the areas of value have been beaten to crap for the last couple of years, and the areas that are completely overvalued and stretched to the point of, once again, I fully admit all the time, I have no idea why things are up here. It's not my job as a trader, it's not my job to try to explain why things are so high or why things are so low. My job as a trader is to take the trades, put it on, not understand what the market's exactly doing sometimes, because sometimes things are completely beyond valuations. Sometimes things are completely beyond anything you could think of. Cocoa being a good example of it this year. Tech, semiconductors last year, and so on, NVIDIA last year. These are completely beyond what anybody could have believed could have happened. So seeing the pullback here isn't that surprising for me. Kashyap, you can go ahead and jump in, because I know you probably have some great insights on this as well.
Thanks, Jason. So first of all, it's tax season, and that always tends to be a liquidity drain from the markets. And I made a post on this topic on Twitter today about how the Treasury General account is going up and bank deposits are going down, and how this is pulling liquidity out of the market. And the thing about this market that It took me a while to figure out as well, because every single day for the last probably 2 years, I think it was Jan 2022, where the first rumor of a Fed rate hike came into the picture, and you had that brief sell off. And since then, since March, everyone has been focused on rates. And sure, rates have an effect, but it's all about the liquidity. And even though we have this environment of incredibly high interest rates, which is hurting a lot of people, we also have this environment where liquidity has been really flowing. And that's not coming straight out of the Fed balance sheet, but it has been coming out of other accounts. They have been able to pump liquidity in the markets in other ways, like draining the reverse repos, getting banks to lend again following the Silicon Valley Bank collapse. So you had all these factors that was adding liquidity into the system. And the first 2 weeks of April is when we saw that liquidity kind of falter. And it makes a lot of sense for that to happen, because you had a record run last year. A lot of people made a lot of money, and now they are paying their taxes. So what happens when they pay their taxes? They have to pull money out of their accounts in one way or the other, and that money goes into the treasury. So when you saw this happen, you saw the markets kind of start to pull back. And here's the thing about these pullbacks, right? So we've had a constant rally since the beginning of November. It was 4 straight up months. Now, after you have a run like that, then you have kind of the market just going nowhere, sitting for a while, and then you have the first down day. Doesn't even have to be a 2% down day. All of a sudden everyone is panicked, everyone is selling, everyone is just hitting the bid, because, well, that's your first down day. What if this is the end? And maybe this is the end. Like, you don't know. This tech bubble has gone on for such a long time that maybe this is the end, and the concentration is so heavy that maybe this is the end. And by the end, I mean, what you would see happen is 2022, especially 23, the index outperformed everyone. Everyone made fun of the active managers, saying, look at this index, it's doing so much better than you guys. Why should we give money to you? And then first quarter of 2024, it was Nvidia's up 70%. You're underperforming. If you don't have 7% in Apple and 4% in Nvidia, what are you even doing? So now, when we see this correction, I am guessing, but I mean, like, no one knows, right? So my guess is that you're going to see active managers wildly outperform, because they are going into the areas that are showing strength versus technology, and you're going to see the index underperform because the index is just too concentrated, and these names are going to sell off. So even though the market's going to correct, I think pretty much everyone in the industry is going to have a really great year, and they're going to find it so easy to outperform the index that the index is going to become irrelevant. So you're going to see huge down days in the Nasdaq, huge down days in the S&P, while gold goes up, oil goes up, copper goes up, maybe even Bitcoin goes up, maybe biotech goes up. Like, you're going to see so many pockets of strength in industries and sectors and the kind of stocks that were left for dead, that active managers are going to have a great time, while the passive crowd is going to cry about underperformance, and they're going to figure out that the fees for active is actually worth it. So I think that's the kind of setup where we are headed. And the price action shows this. So we had scary days in the Nasdaq, and gold didn't even budge. We have all these whipsaws in oil, and the oil stocks are just going up. They're not going down. Some of them are going sideways, but mostly they are going up. And you have Biden talking about SPR releases, and gasoline is still going up. It's not declining. And copper is in a completely different league of its own. The way it's running, I've never seen copper run like this, except maybe during the time when the China joined the WTO, and you had this huge boom in commodities, the 2002 to 2007 cycle. So copper is running like that, and there's like absolutely no reason why it should run this far. There are fundamental reasons why it should be at these prices, but there is absolutely no reason it should just go straight to 4.4 per pound. Like, that move is just wild. And you're seeing the same in cocoa. Like, sure, there are issues with production with the virus and the insects and everything, but there's no reason it to just keep running. But it is. And I think all these moves are just a sign that liquidity has started flowing to sectors that people have just given up on for so long. I mean, there used to be a running joke back in 2022, 23 that you buy a 8 PE stock, you lose money because it becomes a 4 PE stock. You buy a 4 PE stock, you lose money because it then becomes a 2 PE stock. And I had trades like this. So I remember my first trade in Sim integrated shipping, which went exactly this way. And then the stock became hot on news of the war. And now it's picked up and it's chopping around. But you have all these kind of stocks behaving this way in multiple sectors. And when these stocks start to move, people realize it is so cheap, and so they chase. And that's happening with coal stocks, that's happening with gold miners, that's happening with copper miners, that's pretty much happening everywhere across the board. You had a mini bubble in home builders, even though mortgage rates are too high. And why did that happen? That's because people anticipated the Fed easing, and they saw the market improving, and so they chased home builders up. So you have all these. So whatever kind of trader you are, whatever sector, if you are looking outside technology, outside the broad indices, you are actually doing pretty well. And that's something that you couldn't say for such a long time. And that's a function of liquidity coming into the markets. That's a function of the sector rotation that's underway. And the cool part is, even though this has been happening for the last couple of months, almost no one is talking about it, or almost no one is looking at it. Everyone is still focused on rates, everyone is still focused on tech, and they've not realized that the market has moved. Their investors have moved elsewhere and they are making money elsewhere. So there's still this great window to get position before the big money starts coming in.
No, I completely agree. I think it's one, it's very hard as an active manager, because when you're an active manager, you deal with so many people trying to tell you how you should handle the markets. Meaning, should you handle the markets in a way that should you put all your money in the NASDAQ and walk away? Should you, what are your clients telling you? Your clients, some of your clients have retired, like, especially if you're an active manager, some of your clients have multiple accounts. Some of your clients have accounts that are retirement accounts that are just, they give their money to somebody and it's in the S&P 500. Sometimes you have clients that have their nephew, hey, like, I'm going to give my nephew $50,000 and let's see how that goes. And they do these things, and it sounds kind of crazy, but it's like, this is the truth. And then they'll say, when one of them's doing well, they'll send you that portfolio to see this portfolio is doing well. And I think your goal over time, especially like if you look at my returns over time, like, they're great. But if you look at it like in a month to month or a quarterly basis, or whatever, like, there's times where the indexes outperform. There's times where somebody's nephew during that time with GameStop and everything else going up, and the F the man stuff that was going on at that time, and we're going to stick it to all the hedge funds, like, you're going to have periods where those people are outperforming even. And then they're really confused and going like, why am I giving this person money if my nephew can net 300%, and it's the real thing that makes you a professional is that you just don't give back all the gains. That's the only difference. Like, I don't do anything that different from anybody else. I just don't tend to give back all of my gains as much. Because what happens with, especially the index investor who's going to hold for the next 30 years, and then, it's 2008 and they're going to panic out at the bottom like everybody did. Like, when you're looking at those type of situations, of course, you're going to have these great outperformance periods, but you're going to always sell at the complete wrong time. You're going to try to buy at the wrong time. You might even get lucky just buying at the wrong time, and then you're going to think you're really smart, and then you're going to continue to hold on to it for the next 20 years. I mean, it's literally a losing game to do that. So I think that as an active manager, whatever you are to be active, some of us, I trade futures, I trade ETFs. Between all of those and trading all of those and running that type of money for people, and being very active doing it, there's people who will look at it and go, well, what are the tax implications? Maybe I could do this differently and my taxes will be better. Or maybe if I didn't invest with you, this would be better. And they kind of go down a list of all these things. And really, it's like, you can't think of trading like that. Trading is very tactical. It's very hard to do. There's going to be periods of time of underperformance. There's going to be periods of time where the market's completely conducive to your style of trading, and there's going to be times where it's not. The best thing you can do is be, as an active manager, is figure out those times where you want to be heavier in cash. Sometimes a fundamental person might go more to cash when valuations look crazy, and whatever models they're looking at tell them that they should probably be raising cash. As a technical trader, like I get neutral signals. Like, I don't run systems that are like a moving average crossover system. It's long and short all the time. I think that's a terrible way to trade. I think a better way of doing it is to have neutral signals, meaning that sometimes there's points where there's nothing to do in certain trades, and of course that makes perfect sense. So I think that really, as active managers, we have to kind of be able to sit on our hands better than other people, not panic and get stuck into that movement or that moment where you're like, okay, well, I have to, as a trader, I have to outperform. I have to figure this out. Like you said earlier, we were talking about those guys the other week that put all their money into Apple, and they're starting to go, well, hey, I have to be an Apple then. Hey, I got to buy some Apple stock because this is going to make perfect sense, and my clients are going to hate me if I underperform the index again. And it's just like the difference in somebody who's been doing it for a long time. I mean, look at Jerry Parker, great example, great guy, great trader, has been doing it for a long time. I think the thing that always interests me with Jerry is the fact that he has the ability to really just stick to his plan, stick to his system, trade that plan consistently all these years. It's very hard to do that. You don't see many people have that type of discipline. And I don't think it's that everybody has to have the same discipline as Jerry or trade like Jerry. I think it's the discipline of, hey, I don't really care about the indexes. Hey, yeah, I'm trying to avoid drawdowns. Hey, yeah, I have all these, I have all these different things I'm trading, sure, but that's because my goal isn't to, have volatility. Just understanding your goals, understanding who you are as a trader, understanding the way you want to be positioned. I mean, he said it on the show the other day. It's like, I say the same thing over and over again. And I was like, that's funny, because I was like, that's kind of your edge. Like you make fun of it and you make a joke about it, but at the same time, like that's an edge as a trader, is to just continue to do the same thing over and over again. Understand that the markets aren't always going to like your style of trading. The markets owe you nothing, so you're just going to continue to do that over and over again. And I think it's been it's a blessing to really see someone who works like that and does it in that sort of way. So once again, I think there's so many facets of how you have to do this as a trader, and what this market looks like and what it can look like going forward. Like, we don't know it's going to look in a way, and like Kashyap and I have talked about ETFs before and the way they're constructed, and yes, sometimes the bigger ones, the way they're constructed, they'll give you that trend following aspect. If they're a very small cap name, like, they're going to kick out the big names, which doesn't really give you a trend following aspect to it. But also, because of that, when you get so weighted in something like an Apple, like Amazon, and let's say we move out of the regime where tech is leading the way, then you're going to have this huge drawdown. You're going to get hit badly, because guess what? The thing that has gone up the most is now the laggard. And then once it's the laggard, it's still the biggest thing in those ETFs or the indexes. So once again, you have to be very good at being tactical. Like, where do I move to then? Like, and you can do it many different ways. You can find individual stocks. You can find commodities. You can trade across the macro sense and find, different trades or longs and shorts and so on. You can find ETFs and find different sectors that you want to trade, or different commodities in the ETF space and so on. Like there's a lot of ways to do it. But, the thing I'm seeing, Kashyap, and we could talk about this a little bit more, is that the people who made their money in the growth trade and the tech trade, they continue to talk about the growth trade and the tech trade. It's still the thing that they're all talking about. Hey, this is the trade. Hey, this is going well. I'm gonna buy this dip. This dip looks perfect. Tesla's gonna go back up again soon. Like that's what I'm seeing more than anything else. I'm wondering if that's what you're seeing as well.
Oh, absolutely. Everyone is still in the last trade that went really well. And even worse, they are averaging down because now they are down 10% from their peak and they think, oh, the next move up, I'm going to make a lot more money. And you're seeing this craziness everywhere on Fitbit. And I just don't get it. I mean, sure, you made. So the interesting part is there is this one account that I follow called I am Oil Tanker. He's been long oil tanker stocks all the way from 2020 to 2024. And recently he switched the name and said, I am not Oil Tanker. I've taken my gains. I'm riding off into the sunset. Goodbye, guys. And that is such a refreshing thing to see because I literally haven't seen that across Pinterest. So I followed the uranium trade since 2019, and usually what happens is they just ride the wave up and down, up and down. They squawk the loudest when uranium is doing well, and then they kind of just stop talking about it when uranium corrects. Same thing with Bitcoin, same thing with tech, same thing with pretty much anyone who's tied to one asset class or the other. And I think this is really the bigger problem with indexing, right? So when you have this cult of indexing and trying to outperform the Max 7 or trying to outperform the S&P, or now it's the Nasdaq 100, everyone just focuses on one asset class, which, if you think about it, is insane. So how many stocks do you have listed in the US? Maybe 5,000 plus, and no one cares about anything except for 50 stocks. Now you get this kind of mania. What about the people who are buying the other stocks? What about the people who are figuring out trades in Forex, figuring out trades in commodities? All of those, like you have completely shut your mind to the possibility of making money in everything else. And like everything in markets, this will rotate too. So I remember the period when commodities were booming. Everyone was interested in exposure to Brazil and Argentina and all these exotic locations. Or when gold and mining stocks are booming, people want exposure to Africa, they want exposure to Latin America, they want exposure to Mexico, they want all these exotic stocks in their portfolio. And then the cycle switches, and then it's like, no, we are done with that. And right now, we are in this phase where everyone who's invested in pretty much anything outside the Nasdaq, the S&P, or the tech stocks has just had a brutal couple of years, and that makes total sense because interest rates went up, and tech stocks, they are cash flow generating stocks. They don't have a lot of debt, whereas any other business relies on debt. So you take the rate up, the returns on the equity go down, investors have a miserable time. You take rates up in the US, the dollar went up, and anyone who was invested outside the US had a miserable time. So you had this flow of money coming out of Europe, Japan, India, pretty much all Asian countries. In fact, everywhere in the world, you had all this massive inflow into the US because you gain just by having exposure to the dollar compared to your local currency. So it's like, why would you not take the free alpha that's being offered? So that's what people did. So everyone who was invested outside the US, outside these very few niche stocks and this these 2 3 indices, right? That's all it is. It's just 2 3 indices of maybe S&P 500 is just 50 stocks, Nasdaq 100 is just 7 8 stocks. So anyone who is invested outside of that has underperformed so badly that now is just reversing. And it's not apparent yet because you have had so much pain in the space. Everyone is just focused on the pain. Everyone is just focused on, I just have to make sure I can keep my capital until something changes. And even though something is changing, everyone is in so much pain, they don't want to really believe that something is changing. And it's just been less than a week, and less than a week of market correction isn't really going to do it. So, if this is the start of a trend, I think we are going to have a long period of everything outside the US outperforming. And that's when you're really going to see people stop investing in these passive products and start going and finding alpha. And I think that day is very near. So the the way the price action looks to me, so ASML reported earnings, and earnings weren't bad, but they said visibility into future earnings kind of looks iffy. And that started a big correction across the entire semiconductor space. And it's not stopping with semiconductor, it's hitting all the growth stocks, all the tech stocks. And even with all this happening, so you have, let's say, a 2% intraday move in a company like Nvidia. So that's $2 trillion company. 2% move, how much is that? It's like, that's pretty much more than the market cap of the biggest gold miner. And what happens to the small caps? Nothing. The capital is going into the small caps. It's not that earlier what you would see is when you have a big stock correcting, it will drag the entire market down with it. The entire market meaning pretty much all the listed US stocks. And now what's happening is that you have these big stocks correcting and all these small stocks going up, which is really change, which is something that we haven't seen in a long time. And I think once this gets going, this whole indexation, or you have to be in Apple, you have to have your index weight, all this craziness will go away. And the famous Warren Buffett bet, where he bet sometime before the 2008 crisis, he bet a fund manager that in 10 years, the S&P will outperform the hedge fund index. I mean, first of all, it's a poorly constructed bet because this is comparing one index to another and not actually an active manager's performance. But you have all this hatred towards active, mainly from people who have made a lot of money just following the narrative, just following the Jack Bogle philosophy of putting their money in Vanguard. And you have seen active managers fire back by kind of becoming passive indexers themselves. And now finally, the active managers who have given up on active and become passive but with a 2 and 20 fee, they are getting the same performance as the market. And so what's happening is finally investors can see this is nuts. We have to invest in something outside of this narrow concentration of stocks. And finally, we have the ability to do it because something other than tech is going up, something other than the Mac 7, the Mac 4, the Mac 2, something other than these stocks is going up. And energy is outperforming. The geopolitical backdrop for doing that is good. And so let's buy energy. Gold is outperforming. It's having its day in the sun after 13 long years. Let's invest into that. And then you're going to find pension funds and institutions start to look at, can we invest in managed futures? Can we invest in with CTAs? Like, let's move capital out of US tech and into all these other areas. And I think that's where finally active management will pick up, and all these passive products and all these overvalued tech stocks, they'll correct. Like, do you really want to pay 15 times earning for a tech stock which is now growing revenue at 5%? You would if the stock price is going up 5% a day, which is what was happening. But now you have investors pulling money out of these stocks. So those stocks are correcting. And you have investors putting money into a different set of stocks, the cyclicals, even the defensives. So you're seeing the rotation that you're seeing is going to completely change the way people allocate to passive. And that's also because investors aren't dumb. So the reason they have been chasing the Max 7 bubble is because that was pretty much the only game in town. If you didn't chase it, you got redeemed. So what do? You have to chase it, and you did. And now, because you have other options, you're going to go for those options. And investors who pushed managers into chasing those bubble stocks are now going to say, hey, you used to be an energy fund, right? So go back to being an energy fund. We don't want you to have a 7% weight in Apple. We don't want you to have a 4% weight in Nvidia. You run managed futures, great. Here's some money, go trade Forex. And I love this Jerry Parker's acronym, right? Trend following plus nothing. And that style wouldn't have really won favor when you have this period of narrow performance because you're never going to run a concentrated trend following strategy and the diversification would have killed, whereas that style would come back. You'll have so many different management styles that will come back. And instead of just selling options because the wall is so low, you get to capture the premium, you're going to have different strategies in the option market. So I think what's going to happen is you're going to have, everyone's going to have a great year in 2024, except people who are narrowly invested in the indices or narrowly invested in the few stocks and the few things that did really well in 2023. So I kind of see that's where it's headed.
No, I like that because I think that's something that's like, one, it's just going to be a thing where people have this idea that the markets have to work a certain way. And it's mainly to do, and you and I know this from doing this for a while, it's mainly to do with however they made money in the first place. If you made money in the first place as a trader who is just always making money on the long side, you will probably have a long bias. If you're a trader who has made money on the short side, you will then have a short bias most of the time. And it usually has to do with whatever market environment you came into. And you have to either figure out a way to get rid of those biases as a trader or not. It's kind of like, you buy the Bitcoin bull, like, in every year you continue to think it's always going to be a bull market. And as a trader, it's more like, it's not that it can't go up more. And it's not that I'm not suggesting people have like a little bit of money in Bitcoin and just hold it for, a long time. That's not what I'm saying at all. I'm saying if you have a specific trading account and you're a trader, you have to understand your goal is to get in and out of those trends, make, or however you do it, targets, catch the meat in the middle, however you want to do in the move. There's many ways to do it. Your goal as a trader is to be tactical, and your goal as a long-term investor is different. Like if you're a retirement person and you're just stuffing money into the S&P 500 and some bonds, I don't recommend that. I'm just saying if you do that, it's a completely different thing. So once again, when we get to the idea of active management, we have to know that as active managers, all of these different strategies are important. And once again, all of these people that are the fund owners, people think that's the smart money. That's the dumb money most of the time. Most of the people who are handling the allocations and where money's going to go to, that's usually the dumbest money you're going to ever come in contact with. They're the ones that if let's say in 2020, by 2020, a lot of the good CTAs were having trouble in 2018, 2019. So they all pulled their money out of those types of managers and put it into, ETFs or passive strategies, and they got killed after that for a little while. And then the major outperformer was the trend following style strategies and the futures and the CTAs traders. And so it's like, and then people go, oh my God, value traders, value's dead. And so then they pull all their money out of that at a perfect time when you'd want to be buying into that. This happens over and over again. And it's because the people who give out the allocations are usually the people who run the funds, and the people who run the funds usually aren't traders. As crazy as that sounds, I know people would go, "Oh yeah, they must be the traders. They started the fund." It's like, no, they maybe had aspirations of trading, and this is why they start the fund. They have aspirations of trading. They're going to start a fund one day. They hire people, and then they bring them in, and they go, "Oh well, maybe I don't really know exactly what I'm doing." However, they think. Every single fund manager I've ever met thinks the same thing, that they have this magical timing ability. meaning that they can pull money from, you know, a strategy like mine, let's say, and put it into another strategy, and they're just market timers. Or hey, I know they'll write you and they'll be like, oh yeah, you were up a little bit more, you know, 2 weeks ago. I knew I should have pulled, you know, your money at that point. You know, they'll say things like that, and you're just like, it's fucking insane. And we deal with that as money managers all the time. It's fucking crazy. But once again, because of that, this is why you get all these very lagging things most of the time. Like you said, it's going to go through flows. Like, okay, well, tech was doing really well. Right now, most of them are still continuing to go, okay, this is just buyable dips. These are perfect. I'm just going to continue to buy the dips. As my signals start to say, get out of these positions, they're going to be buying the dips. And that's okay. Maybe they're right. Maybe they're not. I'm not saying it's completely wrong to do that. I'm saying the signals I'm getting are telling me that the market is shifting into a different regime. But only until they start to get hit in some nasty way will they start to look at these other areas. I mean, think of energy in 2022. You know, energy was the best performing sector, but you know, the managers at that point were not very interested. I mean, 2021, you know, I just went through the the returns from our portfolio in 2021, and like most of them were from energy. Energy was it was a killer from November 2020 all the way into, you know, basically I think it was March 2022. So these returns were just phenomenal all that time. And at the same time, I remember sitting down with managers that are friends of mine and how they're having the worst years of their life. And I'd be like, you know, what's wrong? Why are you having a tough year? And they'd say, well, you know, the indexes aren't working the way they should have. And, you know, and that's where they get in this weird, like, I think it's always very weird when people say things like, the market isn't working how I think it should be working. Like, that's also like a telltale sign that like you're wrong on everything you're thinking at that point. And we all do it. I'm not saying that, you know, I'm impervious to this. I'm saying that we all have done this at certain times. We all have gone, well, why is the market doing this? And when you start to do that, you have to just realize, well, you're wrong. And, you know, 2021 was a period of time where if you look at the market, it looks okay. But tech was a major underperformer, and everything under the surface was eroding in the tech space. Basically, if you looked at any of the smaller tech sectors, software, and so on, these were just kind of falling apart under the surface. And so many people got stuck in this, like, hey, the market has to do this. I don't know why it's not doing this. And this kind of happened again and again and again, to the point where nobody just said, hey, maybe the trade's changed. Maybe I should be in a reflation trade. Maybe we're going into stagflation. Maybe energy, I should be. Nobody did that at that time. They just kind of continued. So I wonder, part of it's like, I wonder if that's why tech always rebounds in some way, because people are just like, I mean, once again, at some point, this has to change completely. Like, tech could be the biggest. I mean, let's just talk about one thing that's kind of important that a lot of people don't know who are watching, which would be, if you go back to, you know, back in the day, ExxonMobil, when I first started trading, I think ExxonMobil was the biggest company in the market. And then if you go earlier than that, there was, I think Procter & Gamble was one of the biggest companies. And you could just keep going back and you find that all these different sectors were the largest companies. And now tech is the largest a part of the S&P 500, or the broad stock market, so to say. So now that you see the shifts all the time, you have to also understand that, like, maybe I'll have to be positioned differently at different times. And most of the time, these changes happen in a large bear market period. So think of 2008. Well, let's go back. We'll go to the 90s. The 90s, when tech became a very large sector, the biggest sector in the S&P 500 at one point, it was during that dot-com bubble. Dot-com bubble crashes, and then other sectors start to catch up again finally, and they start to overtake. You basically, during that period of time, you wanted to be positioned in financials, small caps, energy. These were the area, gold miners. These are the areas that made a lot of money during that time after 2000, after the bubble popped. And then you got the next bubble in 2008. That crashes. tech never even got to anywhere near the old highs from 2000 in 2007, 2008. And then the crash happens all the way until March 2009. And then when the market comes out of that crash, tech's all of a sudden starting to be a leader again. And then it becomes the biggest part of the S&P 500 again. This is important and significant, and I might be sounding a little bit redundant here going through all this stuff, but this is significant because you have to understand that the market's going to go through shifts and changes. And because of these shifts and changes, you can't really get wed to anything too much. It's even when people ask me about like Bitcoin. And once again, I like Bitcoin. I'm still long Bitcoin in the trading portfolio. I think it's a good thing to even hold a little bit in a long-term portfolio. Great. However, I do have the understanding, just because of what I've seen, what I've lived through, and studying market history, that crypto one day could be completely different than it is today. Think about, people buy all these small companies in the crypto space. Not saying it's a terrible idea, not saying you can't make money doing it. You can make a lot of money doing that, but you have to be tactical about it. You have to be willing to get out with money. Think about the dot-com bubble. We get the crash. What actually ends up continuing after the crash? What is here till this day? Well, you have Apple, you have Microsoft, but a bunch of companies disappeared and are no longer even in business at all. AOL is gone. That was one of the first internet providers in the United States. That was a huge company. Yahoo. You could just go down the list. There's all of these companies that are just kind of gone now. Yes, they exist in some way, but they're not anything. They were behemoths back then. And their stock, I mean, I don't know if I could say behemoths. Their stocks were behemoths. They were starting out and people were speculating on them. But mainly my point over everything else is just understand that things change. And because things change, you have to be willing to adapt to that change. You can be I'm a shorter term cycle investor, meaning now I'm positioned in energy, the reflation style trade, and so on. And I was positioned in tech for 2023 into earlier this year. But you can be that style of a trader, or you could be a more longer term cyclical trader. And like my great uncle was someone who would go, okay, well, 2000 happened. Now I'm going to go into this micro caps, these gold miners, and so on, and hold those for 8 to 10 years. There's many ways to do it, but I think you always have to be tactical about moving around different sectors, different strategies, if you're trying to make money in the long term, especially if you're not very good at individual stock picking in itself.
That's so true, and I think that's again a message I think that needs to be repeated, because no one's talking about it. Like, even if you look at what's on Yahoo Finance and Bloomberg right now, everyone's like, look, market is correcting, market is collapsing, rates are too high. This Fed governor saying this, the other Fed governor saying that. And that's pretty much all the coverage you get. Or maybe you have some coverage on oil and gold, which is tied to whatever is happening in the Middle East. And that's it. No one takes the broader perspective, because, well, that doesn't tell stories, right? Just telling, if Bloomberg prints a headline saying investors should rethink their allocation strategies and explore new areas, no one's going to care. Whereas you print a headline saying Nvidia is correcting or tech bubble has burst, everyone's going to care. And sure, there's value in these stories. It gets people to think, but more broadly, it's not really helpful if you're trading. Because when you're trading, what you're concerned about is, where should I be looking at? Where should I focus? So we talked about this. Like, so I have a watch list of 600 stocks. I think you have a watch list of around 300 futures contracts or something like that. Like, that's your universe. And that's a pretty broad universe. And whenever you talk about it or whenever I talk about it, people are shocked. Like, how do you follow so many different sectors? Well, it's not that I follow them all the time. I just follow them when there's something happening there.
Mm-hmm.
So I've been following the gold miners for close to a decade, but it's not that I'm on top of the news every day. And you don't have to be. You just have to figure out where the liquidity is flowing, which is where I think having that macro framework helps. But having a macro framework, again, it takes time to develop. It's not foolproof, and you have to put in the work. And when you talk to a beginner trader, especially, I see this happen. So we talked about this fund manager who wanted to bring in a day trader because he wanted to have a profit showing up in the account every day, and he
Yeah.
didn't want to do something longer term, right? So this is the kind of thing with macro. So if you're focused on trading strategies, you're focused on your entry signals, you're focused on just taking a trade every day, you really can't devote the time to macro. But if you do devote the time to macro, then you actually can improve, because across all your trading strategies, where you should be looking at, what kind of things you should be looking for, those are more important than just doing your chart analysis. Chart analysis is definitely important, but not the individual trade chart analysis, but the overall market chart analysis. And this is something that we talk about all the time. So let's look at the intermarket analysis. Let's look at what's happening in gold, what's happening with the yen, what's happening with the dollar, what's happening with stocks, bonds, what's happening with the Nikkei, what's happening with China. And you look at this broad cross section, and then you see something doesn't add up. If my framework is right, it should be this way, whereas it's the other way. So should I change my framework? What am I missing? And that's really where you get into the individual trades. And if you don't have this and you're just taking signals all the time from a narrow black box system or something that you bought or you signed up for a signal service, you're going to completely miss out on the tailwind that you would get from the macro. And you're going to always have a short term strategy. So you're going to always think you need to be a day trader to make money every day in the market. And that's so not true. You don't really have to do anything all the time. And that's also the reason that the trend following strategies outperform over the long term, because you're not second guessing yourself sitting through every single correction. You're not second guessing yourself looking at every headline. As long as you have your macro right, you can place your trades, you can allocate heavily, and you can just let it run. And there's something that is so peaceful about doing it this way. So I'm a fundamental trader, but I have learned to do trades this way because it just gives me that peace of mind. So right now I'm short tech. So I've been talking about it for a while. So I published a watch list on all the tech stocks that I would short sometime back in March, I think around the 10th of March. And I have been closely tracking that watch list and seeing the market's reaction to the ASML news. That was my signal. And I just went short all across the board. And this is me completely changing my style in a way, because earlier I used to say this stock is trading for 20 times sales. There is no way this can continue. This is a short. Or this stock is trading at a 8 PE. There is no way this can go even lower. I am going to go long. And I have seen trades on both sides not work my way because the trend was just something different. The market hadn't come around to that view. So once I changed my style to incorporate this little bit of trend following technique into my trading style, it's just been so much more peaceful. And that is really the other aspect of it. So you talk about fundamental analysis, you talk about technical analysis, sure, like people listen, but trading, actually making money, is about so much more than that. These are just a few pieces of the puzzle, whether you're doing fundamentals or technicals or macro or just allocations, or even you're doing the Harry Brown type portfolio where you're in 25% cash, 25% real estate, 25% gold, and 25% stocks. Even something like that, it really helps if you can incorporate a little bit of something. So if you can take the emotion out of it, it just makes it so much easier, because that's the crazy part. So if you had, let's say you have 5% of your, let's say you're a young 20 something guy with a good job and a 30% savings rate, you put 5% of your cash flow into Bitcoin every single month, and you consider Bitcoin as saving. You completely believe everything that the Bitcoiners tell you about money and markets and everything. Bitcoin has its cycles. Even if it goes all the way down to zero because the technology fails, you are still fine because you have put in a small allocation every month. You have learned the discipline. And if one of those investments go to zero, maybe the next investment that you make won't. Or maybe at some point you will figure out that something is wrong and you'll pull your money out. Whereas the guys who are 100% in, or the guys who, so Michael Saylor, who all the Bitcoiners respect. So April or March 2021, he came out and said, sell your house to buy Bitcoin, mortgage your house to buy Bitcoin, take a loan and buy Bitcoin, figure out what else you can do to buy more Bitcoin. Basically telling people just go all in on Bitcoin. Or Rawal Pal had this crazy trade which worked out for him, but he said, I'm all in on gold. No, I'm all in on Bitcoin. I've sold all my gold, all my bonds, everything, and see you on the other side. And people look at this and they're like, oh, so that's how I should be managing my money.
Mm-hmm.
And then you have the first dip, and now they're scared. What do you do? And this dip happens at the same time you lose your job.
Mm-hmm.
Okay, now you're even more screwed. And that's really the other aspect to it. That is, if you're indexing, if you're saying, I'm going to do a 60-40 my entire life because that's what Vanguard tells me to do, and then you lose your job, or you get a divorce, or you have a sudden medical expense coming up, what do you do? And it coincides with a dip in the market, you're permanently crystallizing a huge loss. So you have 10, 20 years worth of savings invested in the market. There's a 20% dip. You're losing 2-4 years worth of savings, and that's crystallized, that's taken out. That's something that you'll never get back. And what happens is people get so hung up on the gains of one particular strategy that they forget it comes with all these different risks. And they forget that it is almost impossible to maintain the kind of discipline that it takes to get those long term returns that the people who run these indices, the people who market these indices talk about. And it is just not possible. And sorry, they also don't realize they have a different volatility profile. I might be able to handle a 10% correction in my account in a day because the stops are set. Worst case, I know where is my catastrophic loss. I'll pick up from that. I studied market crashes. Whereas someone who's, say, 60 plus, someone who's retired and living on that income, if they see 10% of their account wiped out in a day, how are they going to react? And people don't think about all this. And I think that's also what social media is doing. So social media is telling you, look at me, I turned 50K into 500K trading gold options during that run up. So, I'm going to teach you this technique. And that really doesn't help anyone. It's something that you talk about after the fact. Or all these guys who put pictures of them sipping champagne in a boat and saying, look at this trading signal, like you should just buy my system. And like it really doesn't help anyone at all. And sadly, that's kind of where most media is today.
No, it's true. It's funny because it's like the richest people I've met are the opposite. Like they don't have a yacht, they don't have a boat, they don't have any of this shit. Like, of course not. Like, because as a trader, once you start to understand where like a boat could get you, the first thing when you make $100,000, the first thing you're not gonna think about, hey, I need a boat. You're gonna think about, oh, I can take $100,000 and put it in the market and do blank. Like, why would you continue? Like, because the people who are good at trading is really hard. It's a really tough thing to do. It takes years to learn, and you almost have to be kind of a psychopath to do it well. So most of the people who do it do not give a shit about what they have from it or what they gain from it. They like the game. Like I don't care about gaining anything from trading. I care about the game. Like, how am I figuring it out? Am I doing well? Am I figuring out ways to make money? Am I a good trader? Like, am I following my system and my strategy and my plan? That's all I care about. I could care less about any of the other things. If I had to live in a shoebox so I could continue trading, I probably would. And I know that. It's funny because I think back to like being an athlete. It's the same thing I would have done to be as good of a bike rider as I was. Like, I would have still same thing. I'd have slept on the street every single day. If they were like, you're going to be the best bike rider ever, I'd have been like, great, I'll sleep in the street. It's the same thing as trading. Like, people are just obsessed with the game. So you never see, like, the people who are online posting like their new life and these things, and you feel like that's what you need to do because of that. It's just not the case. Most of the people I've met that are like, into the 10, 20, managing 100 million, 500 million, like, they drive normal cars. They're completely normal people. You would never even guess that they make the type of money that they do. And that's incredibly important. One, it's like, you have to understand how to keep yourself humble. Like, you're a trader. You're not, you're doing this because you love to do it. You have to have a little bit of that in you. Yes, you can make money. Yes, you can change your life from it, but you have to have that one part of humility where you just understand that this is what I do because I really love to do it. I've never met anybody who got very good through without loving to do it. Yes, there's people who want everybody. You're trading because you're trying to make money. Great. That's also going to be part of it. I'm not saying that making money is a bad thing or an immoral thing. I'm saying that you have to love this game of it. You have to love either creating systems, creating strategies, waking up and studying the macro every day, understanding the markets, talking about the markets. Like, you have to love some of those things to really do this to this high level. So I think that's important, because too many people are watching like Twitter and they're going, well, like, this guy did this, and it's like, well, how important is one trade to me? Is nothing to me. Like, nothing to me. You'll never see me share my returns for my cocoa trade and be like, look how sweet I am, I've traded cocoa. It doesn't matter. It's one signal and many signals. So what does matter? Well, it's the yearly returns. What does it look like per year? Because at the end of the day, it's like, if you're putting together these returns year after year after year, and you're able to compound those gains over time, that's how wealth is created. It is certainly not created by taking a bunch of YOLO call options and buying a bunch of them and going like, hey, I made a bunch of money this one time, but I lost it the next 10 times. And so at the end of the year, like, I post my one trade that worked out really well, that I made 2,000%. And then I never post the losing 100% on my call options 50 times. Like, that's where it gets kind of messed up in Twitter land. There's a person.
So we both know a guy.
Go ahead.
We both know someone who did this, right? Short the Nasdaq consistently for months on end, and the one trade that works gets plugged as marketing material for the newsletter to say, I caught this correction. And
I caught
of
every
course you
single
would.
short. I have caught every
Yeah.
short in the market. Like yes, of course, if I buy call options today and I buy call options tomorrow and I buy call option for the next 5 years, of course you will catch every single short in the market. But how do you make that profitable? And the answer is you don't. That's not profitable and never will be. It's good for writing newsletters. People will get insanely excited about it. People will say, hey, that guy caught a short. And if you catch the letter at the right time, the perfect time, you can go, okay, well, I caught that letter at the right time, the perfect time. I'm therefore going to buy this newsletter. And the next time he puts out a trade, I'm going to do it too. And then you get it wrong. And then you go, shit, well, what happened? And then you try it the next time, you get it wrong. And you get it wrong again. Then you unsubscribe. You hate the guy. He's you think he's the worst person ever. And really, it's like the real game of trading is teaching yourself how to do it. Like you have to really like understand how you do it, not figure out like what this guy's saying or what I'm saying or what somebody else is saying. I can show you my discipline and I can show you what real trading actually looks like. I just can't show you. I'm not going to lead you the wrong way and show you that, hey, like, look at my one trade here, how great it was. I put all the portfolio together so everybody can see how all of the trades work together. There's losers in there. There's winners in there. Like, I'm not hiding anything in there. So you can see all the trades. You can see the drawdowns in certain positions and so on. But as a whole, it does well. So that's kind of like the best way to do things. If you do subscribe to somebody, find somebody who you can kind of understand what they do and have kind of a open way of doing it, so you can see it. But I wanted to get to this guy's question. So it was here. He also wrote a couple of things, so let me read the other ones too. Okay, so do you have any tips for someone who has been trading crypto for the last 8 years but is clueless about traditional finance, looking at it from an algorithmic perspective? And then he also wrote, all 8 years have been discretionary trading with heavy studying on how to implement automated systems. So I am familiar with trading as a game, but I am intimidated by the traditional financial instruments. And I think this is true. This happens a lot in traders, especially with who get into crypto. They get into crypto and they go, okay, well, I understand crypto, like really, like I'll be honest, like it hasn't, the asset class hasn't been around long enough for any of us to really understand it completely. As much as I'd love to understand it completely, I can't tell you what every back test will look like because it only has 10 years of data. And when something only has 10 years of real data, and really, like, when it's liquid enough is really when you want to get there, and you want to be at that $1 billion level. And that's that's something that, I'm talking about market cap. That's something that industry didn't get to for a while. So once again, you have to start there and go, okay, I don't really know everything about this one thing either. So then what's the next thing? Well, I don't know everything about, he wants to be algorithmic, so I don't know everything about anything. And actually, as a trader, I don't need to. Like, if I'm algorithmic and I'm taking signals based on nothing but my systems and my strategies and my back tests, then why exactly do I need to understand every little thing about every little asset I trade? I think that's very freeing to first just understand that. I talked to someone the other day, and the conversation came up about natural gas going down. And he said, when exactly will it stop? What number do you think? And I said, I have no idea. And he looked at me like I was like lying to him. He was like, wait, how do you not have any idea? You trade natural gas. And it's like, no, nobody has any real idea where everything will go to any place where I can say, hey, natural gas will only go here, natural gas will go up to this, natural gas will go down to this. I think that's a completely unrealistic thing to try to do. I think what's more realistic is trying to come up with your strategy, how you're going to do it. You want to be algorithmic? Great. Then you don't have to worry about anything else, and understand that really all you're looking at then is just how the price is moving, and creating systems and algos to take advantage of that. And if you can just do it that simple way and understand that, hey, like, this is exactly what I do, this is what I'm going to do as a trader, this is who I am, then it's really freeing to just let go of everything else. Like I don't come on here and have conversations with Kashyap or Kevin or somebody and try to tell them, hey, like I know this analysis better than you. I don't. And that's freeing for me, because I know that's not my strategy. My strategy is different. We want to talk about macro, great. We want to talk about trends, systems, great. I'm very good at those things. But understanding that you just don't have to be specialized in everything, and you don't have to know everything about everything. And especially as an algorithmic trader, break it down to just simplification. What do I need to know? Well, I need to know the price action. That's it. And that might sound, simplistic, or maybe not exactly what you want to hear. But I promise when you look into it a little bit more, you'll go, that's exactly what I'm doing. And that's what I'm thinking. Because I deal with it all the time. I had a friend tell me, he wanted to trade some currency pair. And he was like, yeah, I don't know, what the central bank in, I can't remember where it was. It was some obscure country. It was like, I don't know what the central bank in this country's doing. I don't know about this. I don't know their economy. I don't know these things. And I was like, well, like, I don't, if you're trading off the price action, like, why do you have to know all those things? Like, it's like knowing all those things to then just put on the trade and go like, okay, great, I put on the trade. Like, what's the difference? Like, you're going to put it on when you get the signal or not. So just figure out what you're using in your strategy, and then you're gonna do great. And then he said another thing. For example, just applying the turtle strategy to hundreds of instruments with small size. Yes. Just to elaborate on that a little more, run a back test on it. I think that's what will make you feel less intimidated. Like, run a back test and go, okay, this works. Okay, this doesn't work. Understand things like positive expectancy, meaning, like, you don't have to be right on every trade. You can be right on only a few trades and make money. I wonder if I still have that sheet. Yeah, I do. So this is kind of a way of looking at risk to reward or positive expectancy, however you want to do that. But looking at it and going, okay, well, let's say I get 40% of my trades right, I need to have 1 to 2 risks. So basically, what that means, if I'm losing $1, I'm making $2. So meaning your risk, it would be, your stop loss would be at $1, and you'd be looking for your trades to make about $2. And then, what I look for is to try to have this type of strategy, meaning if I'm losing $1, I'm trying to make $5. And if I can do that, I can be wrong a lot. I can obviously even be wrong. I can only be right 20% of the time and make money. So, if you understand those basic things like positive expectancy, risk to reward, and then you put on the trades, you're really going to set yourself apart from other traders like that, because that's the thing that they don't look at. They look at, Bitcoin made me a lot of money. The NVIDIA made me a lot of money. I love NVIDIA because blank. I love, Bitcoin because blank. That's not how we look at it as traders. We have to look at it like, I'm making money in this, and it's going to end at some point. The cocoa trade's going to end probably terribly at some point, like that. I know that going into it. It doesn't mean I do something different. It just means I know that. So I think you're on the complete right path. I see, like, you got a lot of knowledge. You're learning and reading about stuff. About the turtle traders. Keep reading those books. Keep seeing how those people did exactly what they did. And if you want to go that route, that's great. I think you got a good head on your shoulders already. But I gotta get going, guys. Kashyap, as always, awesome to hang out with you. I think we hit on some really good points.
Yeah, this is a really good talk.
Mm-hmm. Yeah, so cool, man. Well, thanks for coming on, Kashyap, and we'll talk soon, man.
Yeah, talk soon. See ya.